Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Friday, May 15, 2015. Inside the numbers tonight, we're going to discuss the Spider and the E-mini charts. We've got some new highs, and I'm going to discuss the impact of that and what to expect going into next week. We'll discuss crude oil and what the obvious support was early on today. Excuse me. We'll talk about gold and how bullish it looks and why. Interest rates in the bond market and the big move we had today. And the U.S. dollar and how bearish it looks. Let's get right over to the SPY chart. So here's your daily chart, and we had a closing high, right? So here's the scenario as I see it, okay? We do have a short-term daily cycle turn day scheduled for Monday. Now that could be, at this point, it's obviously not plus or minus 1 day, right? This would be the minus. So it's Monday plus 1 day. So it's Monday or Tuesday. And here's the deal though. I wouldn't be surprised to see somewhat of a further melt up and a little bit of panic buying set into the market. What do I mean by that? Well, when you start to make new highs, people begin to think they're missing another move, and they may be. So they begin to buy indiscriminately, and that forced buying forces the market higher, and it could easily set off a slight vacuum to the upside for a few days. Now, why would that happen at new highs as opposed to somewhere like this where we actually topped out? Well, let me explain. So here we are making new highs here, and we break out in pretty good fashion and pretty quickly, okay? So we had, on the breakout, we had we had 4 days worth of sideways going after we broke out, and then we made another move higher, and we continued higher, and then we just made a pivot top and rolled over. Now, what's the difference between where we are now, and why is it any different? Because here, you see how long we spent up in this area? This is from this is from the middle of April, okay? So basically, for the last month, we've spent above this downsloping trend line, which is our breakout line, more or less. We had a couple of days beneath it, but for the most part, we've spent the last month consolidating above this line for a move higher. And remember, and I know it sounds like a broken record, but I've been saying the market will make new highs, okay? There was no doubt in my mind, I told you this for months, that we're going to make new highs, okay? We're going to still make new highs yet. The question is, do we pull back next week first or not? And really, the way I'm leaning is, I'm leaning for a little bit of a melt up into early next week. If we see anything substantial on Monday and we see any kind of a topping signal on Monday, that would be the first set of evidence, if you will, that we are that the short-term cycle turn on Monday would be taking effect. But if we have another quiet float day with no conviction, just somewhat of a grind higher like we saw today. Not that we grinded higher today. It's just, probably I should say the yesterday afternoon after we made the big up move, and then we just grinded higher, and then we just stayed there today. If we have light volume with no conviction, I'm not sure if we'll see the cycle turn take hold. But if we see a spike into Monday, the probabilities would increase that we're going to see a turn. Where would that spike occur? Well, I'm going to give you some numbers from the S&P E-mini, which is where I do my calculations. And, basically, we're looking at, let me go back to something here and show you intraday. Because I had been telling you that 2023, 2025 was an important number. And what happened today was, here's the high at 21.2275. And we beat on that early in the morning before the actual pit session opened at 8:30. And what's interesting about that is We never tested that number or satisfied that target that I have on the intraday session during regular market hours. So what I think is more likely than not is that we do have to go up there. And while we're not that far away, earlier today we were far away down at 21.15. And remember, I told you that number was important also. As soon as we broke above 21.15, this line's been in there for a long time. As soon as we broke above 21.15, then we really started going off to the races. And then we came back and tested 21.15 today and made new, went higher in this afternoon. So what I'm saying is I expect the market to test these highs, but I'm not sure that we stop at those highs. There's a 21.30 that I've been telling you about. I've mentioned since late fourth quarter last year in 2014, I've been telling you we had a 21.30, 21.35 number. Here we are, right? We're 10 points away. So that number becomes a reality. And then we can even go higher than that if we do get some of that melt-up feeling that panic buying set in. And that is a possibility. You need to be aware of that. So how do you play it into next week? So here's my preferred method, okay? I'm just going to go back to the daily chart. My preferred method is to be a buy the dip part of the crowd, right? I've been saying that for a long time, and that's been proven correct, and it's still going to be proven correct at least into the summer months. And why do I say this? Well, first let's get back to, so let's say we do sell off on Monday or Tuesday or Wednesday or something like that next week. And by the way, as we get into next week, I'll continue to update you, obviously, and we'll see where we are. And if there's anything substantial on the downside, I'll certainly update you on that, but I don't think there will be. I think that, at least for now, my downside probability is only at 2100. If we break 2100 on an hourly basis, I'll reassess and I'll have some new numbers. And I know the next really heavy level of support brings us right to this purple trend line at 2085. That's an enormous number. So the 2085, I don't think we'll see that Monday. So no worries there. But if we do start down, 2100 is very good support, and then 2085 is spectacular support. So there's your downside if we choose, or if they choose to bring the market down on Monday, and if it's after Monday, well, we're going to talk Monday night, so I'll let you know what's going on there. All right, so a couple of things. Why is the market going to go higher into the summer months? Why do I keep saying that? Because I mentioned this last night, and we talked about this at least a dozen times. It's all the money printing. Remember Helicopter Ben and how they were dropping money in the U.S. markets for years with QE this, QE1, QE2, QE3, and the like. Well, basically, you've got the same thing going on in Europe, you have the same thing going on in Japan, and you have the same thing going on in a stealth way in China. They keep lowering interest rates. Well, what do you think they're doing? They're doing the same thing. Okay, so you have China participating in money printing to stimulate. You have Japan, and I don't even think they've gotten going yet in terms of what they plan to stimulate. And then you have the ECB and Mario Draghi continuing to say the same thing, that he's going to do it until he sees the type of recovery, or that sees the type of advance and positive influence on the economy that he's looking for. So all these things, we ended and they all began. So all told, between China, Japan, and the Europe ECB, they're going to pump more money in than the U.S. did. So what do you think's going to happen? Okay, don't fight the Fed. Don't fight the central banks. What do you think's going to happen, or what should happen, is we're going to see another vacuum on the upside, but this time in a big way. We could see, maybe even another 150 handles on the upside on the SP and the ES contract, or the S&P 500. Okay, that could take us to 2200, 2250, 2300 even on the upside. I'm not saying that's imminent right now, and we'll know, what's going on as we begin to move higher and we see some of the velocity that takes place on the upside. If we see institutional participation on the upside, then we know that they're going to take this market up in earnest, okay? And we'll know it when we see it. But I just wanted to make sure everybody's aware that this is not a time to be looking for, to catch a day or two or three on the downside. This is a time to be looking for the opportunity to get in for a rip higher. That's where we are in this cycle right now. Okay, so don't lose sight of that. All right, let's move on to the gold market. And gold is acting very, very well. I want to bring up the intraday chart because it's worth mentioning that during the overnight into the morning hours, gold sold off from its high yesterday. Okay, no, this wasn't yesterday. This was where do we sell off to? So we have right here. This is the I was right. Okay, so this is yesterday, 12:23.64. This is a 10-minute chart. Okay, and then we sold off to a low today of 12:10.60 at 6 o'clock in the morning. All right, 6:10 in the morning. All right, so you see this line here, 12:12. Remember that was prior resistance. Let's go back and see where that line is. Okay, that was prior resistance right above the 382. Okay, I have had that line in there for a very long time. It was 12:12, 12:15. That was always an important number. Look what happened. Yesterday it came down and tested that line, and today it came down and tested that line. So it's obviously important, right? Okay, so let's go back to the 10-minute. Let me explain this. So the fact that that line held, and we then did another sachet, right? We started up, came down, did a retracement to do a test, but we never got there, and then we rocketed higher for the rest of the day. Now, what does that tell me? What should it tell you? It tells me, and it should tell you, that the gold market is bullish right now. Okay, as long as we stay above this 1212 area, which was prior resistance becomes current support. Okay, so this line has now been proven to be support, right? Look, support here today. Okay, and we went higher. So there's higher prices coming in gold. If this line wasn't as important, and if the market was finished going up yesterday, we would have went all the way back down in this area or lower, okay? There's no way we would have just bounced off of this and finished where we closed yesterday. Okay, basically finished flat on the day after being down here at 1212. So that's my take on it. So what are we looking for in the upside? What we're looking for in the upside is, here are your Fibonacci lines. Basically, now that you're above the 200 period on this is the gold futures chart, I'm looking for 1244, which is the 618 retracement in gold futures. Okay, it's slightly different in GLD, but nevertheless, let's just go bring up the GLD chart. Let's see if we can get a daily chart up here. Yeah, it's roughly the same. So what we'd be looking for is, well, I can put the fib line in here. And so we would be looking for about 119.58. So let's just say 119. Okay, let the pigs have the last few pennies. If I'm long gold, I'm going to probably take off at 119.50 on GLD. That's a great spot because it's a natural resistance point. Look what you have here. You have a prior gap, so you're coming in for the first time to this gap. And then, you'll eventually fill this gap, but on the first hit, you'll probably find some resistance. I don't know how much, but it doesn't matter. The point is it'll probably hit this line, maybe pierce through it, and pull back. That's my take on it. So that's where I see the gold market, in the imminent future. I don't see anything else developing right now that tells me that gold has any weakness here. And if something changes on Monday, we'll review it Monday. But right now, the gold market looks strong to me, and it looks to me like it wants to go up to the 618 at 1244, and that looks imminent to me. Okay, oil. Oil was another interesting one. These lines really work out well, these price levels. Let's go to the intraday. Let's even go to the 10-minute. Okay, so see what happened here. First, let's zoom out a little bit. I want to show you. So yesterday we hit a high. Okay, this was, 2 days ago on the 13th. On Wednesday we hit a high, came down, okay, started making a stair-step way down, all right, and then this morning we come down, and this was at 10 o'clock this morning. We pierced through the 58.63 level. Let's go back to the daily. I know I'm jumping around here. I'm sorry. Here's the end of that candle from the 10-minute chart I just showed you on the 60-minute, which is piercing through 58.63, which is also the 20-period moving average, which is also the prior highs from this consolidation here. Okay, so that line was important. So we had two lines. First, this pivot high, and then once we started consolidating, we put this line in at the other pivot high, which was all this chart support here, okay, and then we came down to test this level at 58.63, all right? So, now, what happened? We made a bottoming signal here, and as we started up, once we closed above this prior red candle here at 58.76, okay, which was in the next candle, okay, that was the low. Even though it was a little farther off the low than some of you would like to take a trade, but when you want the highest probability for success, that's what I would be waiting for on an intraday basis, is to close above this candle, right? Because if you didn't, right, let's say you made this what looked like a bottoming tail, a bottoming signal, which is a doji, and then we had this candle here, but we didn't close above this one, right? This candle closed at 58.72, and the high here was 58.76. Okay, so what we wanted to see was a close above here, because this next candle could have easily rolled over, okay, and we wouldn't have wanted to be in the trade then. So in order for us to feel like we have the highest probabilities in our favor and we've got the best risk-reward trade setup, we wait for that close, and we got it, and then we're off to the races. And our stop would be a close below this candle here at 58.65 on an intraday basis. And then as the market moves higher, I trail the stop higher, and you take it as high as you can go without getting stopped out. So that's the way that rolls. And so just to zoom back into the daily chart, what do we have? Well, we don't have anything definitive right now. We're still making what I would consider a bullish pattern, because now we're above the 20, we're above the 50, we're above our important support levels. There's no reason to call this market bearish, okay? And there's reason to think that higher prices are coming, but we don't have anything definitive yet telling us so. But if one wanted to be long this market, you could have a close below basically on an hourly basis below 58.63 and take it from there. Let's go over to the bond market. We put in the low today in the bond market for an interim basis. And this is what we were looking for. Again, same scenario as oil. We didn't catch the low because we didn't get the signal that didn't set us up with a bottoming signal on the low. But nevertheless, we never got down to our ultimate support line, but we did make a low. I said there would be some support here. We were just wishy-washy. I was wishy-washy on whether we were going to make that low. Wanted to see more. Needed the market to tell me more. I don't need to risk capital to try and say looks like a bottom, feels like a bottom, should be a bottom. Now I could say this is a bottom, and any close below this candle here, okay, at 120.29, I stop out and something else is developing. But right now, I can be long this market with that stop, looking for higher prices, certainly looking for higher prices into what will be a neckline here of the 20 moving into the 200-period moving average, which will be at about 123 and 3/4, 123.75. So there's your bond market trade. So now you're starting to see lower yields come in. And what happens with lower yields? Go back to the stock market. A lot of times with lower yields, you're going to see higher stock prices, right? It's a liquidity trade. Liquidity is coming out of the bond market. Where does it go? Into the stock market, okay? That's just the way it works. Let's go over to the dollar. Unlike the bond market, we do not have anything definitive. We're telling us that the dollar is bottoming. And so we do have very good support here at 92, 88, 89, but we didn't hit it. And had we hit it yesterday and bounced off of it, I would feel better about saying it probably will hold for a while. But since we're hovering here, I'm definitely not bullish the market right now. Long term, I'm bullish the market. Short term, I still think there's lower prices ahead. So until we see something like we saw in the bond market definitive, then there's no reason to touch the market. You just leave it alone. It's a no trade. Just find something else. I think that's it for tonight. I'm going to leave it there. I'm David Frost. Hopefully all this stuff is helpful and you're able to make some dough using it. Take the price levels, use them to your advantage. Have a great weekend. Thanks for tuning in, folks.